Hi, everyone. Welcome to this week's market commentary. This week, we don't have Philippe with us, but we have Freddy with us. Hi, Freddy. How are you?
Hey, Stephanie. Good to see you again. Time passed quickly for sure.
Definitely. This week, we have a lot of headlines about the Fed, concerns around tapering and interest rates rising. So, Freddy, can you share your view on that? Should we be concerned?
Oh, it's an ongoing discussion for a while now. It's never going to stop because in the first place, the pandemic triggered a lot of stimulus from the Fed. And the ongoing question is always going to be when they're going to pull the punches, right? Pull the punch bowl away from the party. Now, however, I just want to round it up with a concept that the market is forward-looking. So we also need to look at what is being priced in by the markets. Now, at the moment, before the next update of the Fed's so-called dots plot, which is the members' expectation of where interest rate should be next year, next 2 years, next 3 years. There's also a similar expectations in the marketplace. So at the moment, the Fed dots plot is actually not so aggressive, but the market has already, in particular, the Fed funds futures market has already moved forward to price in a more aggressive Fed, where the market now expect the Fed to start hiking close to 3 times for the whole year of 2022. And the Fed dots plot median is only barely even a hike. So the market is already moving ahead to prepare for the faster tightening cycle by the central bank. And the numbers for 2023 is similar. The Fed's median interest rate for the Fed funds rate is about 1 percentage point. However, the market already moved to 1.6. So that's a lot of preparation already done. And that's the good news in a sense that when the market is already preparing a lot, and if the Fed actually get more aggressive, the market is ready for it. And yet, global markets remain strong. We remain at these elevated levels. And it goes to say that this could unlikely to be an issue. And lastly, there's also the situation that's ever changing in the COVID pandemic that can change the picture too. So.
Yeah, definitely. And I think that's one of the kind of unknown factors that we still have to monitor quite closely. Because if we think back to the Fed's decision, the Fed actually moved towards tapering when the second wave in US died down post the summer. However, if you look at the latest figures, it seems like cases in the US are starting to ramp back up again, especially if you look at states like Michigan. Actually, the number of COVID cases already surpassed what they experienced in the last 2 waves. Now, of course, the death rates are a lot lower. So, I mean, this time around, the economic impact may not be as much as before. But I think this is a situation worth kind of monitoring, not just in the US, right? But if you look at Europe, cases are surging, particularly in Germany. So it remains to be seen like how governments react to the third wave, especially as we enter into the winter, because I mean, this is a flu season, and how do different economies actually cope with that? But it seems like one thing may not change, right? It's inflation.
Yeah, I mean, what we can learn from the pandemic is that inflation is not going to go away for a few years, in the sense that whenever the wave comes back, like Stephanie has described, the supply chain disruptions comes back again. And it's not like it's easy for industry to just sort of adjust and remove the problem right now. These things takes time to adjust, right? Those change. So be ready for more disruptions at the ports, shipping, raw materials can go up again, energy prices, who knows? There's this interesting dynamics between US, China, and India releasing their oil reserve to try to temper the price increases in energy. And yet the OPEC plus countries are also organizing themselves together to reduce supply to maintain prices. It's a tug of war. This inflation thing is quite sticky at the moment. It has momentum.
Yeah, definitely. I mean, this is something that may kind of change as well as the situation develops.
And it's kind of what we've been preparing users
Exactly.
since July this year. As you know, we re-optimizes all our users' portfolios. Primary reason is to ring fence the inflation risk. We've been broadening investments into energy-related areas, inflation-linked bonds. Gold remains a core stapler that benefits from it. And also even the equity markets of country that actually are commodity exporters is another interesting way where we did in July to sort of maintain growth and also acquire the inflation protection. So we've done everything since July, and it's going to be quite a while before that picture would change.
Yeah, and we can sort of say that we're a little bit even ahead of the Fed as well, because the Fed has been saying transitory for a long time until a month ago when they changed the language at the meeting, acknowledging the high inflation risk. So maybe, Freddie, we can move on to some questions from our audience. So we have one question from Samuel regarding healthcare technology stocks. So as our audience may be all aware, we launched 3 thematic portfolios, the tech enabler, consumer tech, and then also healthcare technology. So healthcare technology has been suffering lately. And the question from Samuel is, with interest rates rising, growth stocks, particularly healthcare, has been hit hard. Is it now the time to buy the dip and will it recover? Or do you think this basket of stock is overvalued?
You see, the core principles behind the thematic portfolios, the first 2 actually done well, but it's not a short-term thing, because you are investing into something that has this long-term impact on societies, on the environment, and how we live, how we operate. It's not something that's going to go away. In fact, it's something that's going to keep changing the world for the next 5, 10, 20, 30 years. And in this case, for the question, the part of the healthcare team that recently has dropped, a lot of them are related to genomics and immunology. And some of that is due to, the valuations being a little bit high a couple of months ago, is taking a breather. And the way I look at the price action is actually a fairly normal kind of correction. That's actually an opportunity for savers like on our platform like us, to dollar cost averaging into building your exposure, right? Because your exposure is going to be a very long-term thing, and you can take your time to build it. So I think that's great for the average investors, but for the lump sum investors, it could be annoying. So I would always recommend that, thematic exposure is long-term. The journey is rocky sometimes, and sometimes the things with a disruptive nature, they are a little bit early in the cycle. They could actually, the volatility is always going to be there. We always make that clear. So you must actually tailor the way you deploy your funds into these things according to your financial plans, right? We are not trading these teams. We are investing in these teams for that very, very important future, right? That very impactful future. A near-term correction shouldn't derail you from something that you believed in, right? So I'm not here to promote a particular team as well. I just want to clarify that, we take a long-term view on this. That's precisely how we design it. And it seems like the immunology and genomics area recently had a correction. The rest of healthcare tech, but the value proposition of healthcare technology and innovations does not change.
Yeah, exactly. I think it's important to stay invested for the long term and think about kind of longer term goals that we can benefit from.
Sorry, I also want to add another point, Stephanie, that we do recommend people think about the risk level when they invest even in the teams. So consistent with what StashAway has always done with any of our products, a team could be very risky if it's 100%, right, exposure in the team. What we've done is to introduce a variety of risk point, and you'll find that the impact on the lower risk point would actually be a lot less significant. If that's what the user is comfortable with and concerned about the short term, you can always adjust your risk level to sort of reflect your comfort zone. So I definitely strongly urge to consider thinking about it from the planning angle rather than a short-term market / trading angle.
Yeah, definitely. And if our audience need a refresher on like the StashAway Risk Index, I mean, we have plenty of resources on our website, and also please feel free to reach out to us. Happy to explain that. So with that, we'll go through some of the upcoming webinars. In Singapore, we have Growing Your Wealth with SRS Investing. That's Wednesday, 8th of December, 7 p.m. In Malaysia, we have What is Your Financial Plan B? Also Wednesday, but this is like December 1st, 6 p.m. And on the following week, Wednesday, 8th of December, also for Malaysia, we have an inside look into StashAway at 6 p.m. So thank you very much, Freddy. And everyone, have a great week ahead, and we'll see you in 2 weeks.
Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.